We're going to continue to talk about fixed assets, but we're going to talk about some other cash outlays that may happen for our fixed assets. We're going to be talking about whether it's a revenue expenditure or capital expenditure. So the word that you see in both of these is expenditure. Expenditure means that we have a cash outlay. That is, we paid cash. In each of the 4 examples, you see the word paid, because we have paid in each one. So in each one of these, we will be crediting cash because we did pay for them. But we have to ask ourselves, is this a revenue expenditure or is this a capital expenditure? If it's a revenue expenditure, that means we paid towards something, toward the asset that is not long-lived. It is going to benefit us for the current period. And it's just going to be there for, in this example, this truck is here to help us earn revenue. And we just need to keep it maintained and repaired so that we can keep doing what we're doing, which is to earn revenue. So that is how we're going to remember that that is a revenue expenditure. If it is a capital expenditure, that means that whatever cash we pay out, the cash that we paid out is either going to add value to my truck or extend the truck's useful life, which means it makes the truck last longer. In the first one, I paid $48,000 for a new truck. That one is easy. I buy a truck and I pay cash, and it was $48,000. Another way to say this is I capitalized my truck. I put it on the balance sheet because it is going to benefit me for the next few years. In the next one, I'm going to add a hydraulic lift to the truck. This adds to the value of the truck. It doesn't do anything for the engine. It's not going to extend its useful life, but it does add value. So for this entry, I would add it to my truck because it adds value to my truck, and then I would credit cash. So here I have the before engine and then I have the after engine, and the engine has been rebuilt, and I paid $6,000 to have the engine rebuilt. So this is going to extend the useful life of the truck. It doesn't add any value, but it does make it last longer. So what I do here is I reduce accumulated depreciation because I'm going to depreciate it for longer years. So we're going to debit accumulated depreciation for the engine rebuild, and our credit will be to cash. And the last one is an oil change for maintenance, and that is not going to be add value, or it's going to be what we call a revenue expenditure. Any maintenance that is happening is not long-lived. It is always a revenue expenditure. So it's usually a debit to an expense account, usually repairs and maintenance expense, and then that was for $45, and then a credit to cash for $45. So let's go over how to classify these. So the first thing I want to ask myself is the cash outlay long-lived? Well, for the oil exchange, it would be no. So it would be a revenue expenditure. And that's why we debit repairs and maintenance expense. Okay, let's look at the hydraulic lift. So let's look at this question. Is the cash outlay long-lived? Yes, this is long-lived. It's going to benefit us for more than 1 year. And does it add value to the asset? Yes, it does add value to the asset, so we will debit the asset. It is a capital expenditure. Okay, let's look at the next one. Does it extend on the engine rebuild? Does it extend the asset's useful life rather than adding value? Yes, this does extend the useful life. It will make it last longer. So we would debit accumulated depreciation to depreciate it longer. So that is how you classify these cash outlays as either a revenue expenditure or a capital expenditure.